Today, we're digging into Sampo, a huge European insurer that has just pulled off one of the most incredible transformations I've seen in a while. They basically tore up the old playbook, going from this complex, messy conglomerate to a lean, mean insurance machine. And honestly, the results have been pretty amazing.
But let's just cut straight to the chase, right? To the number that really matters to any investor. How on earth does a company manage to hand back a massive 7 billion euros to its shareholders in only 3 years? Now, this wasn't just some lucky fluke or a one-time accounting trick.
No, it was the direct result of a radical, deliberate, and super focused plan to completely rebuild the company from the inside out.
All right, so here's how we're going to break it all down. First, we'll unpack that massive transformation. Then we'll look at the bull case, what I'm calling the Nordic fortress, and balance that against the big risk, the UK gamble. After that, we'll see exactly how all this rewards shareholders. And we'll ask the big question, is the stock actually worth its premium price? And we'll wrap it all up with a handy investor checklist. Let's jump in.
Okay, first up, the transformation. This really is the heart of the whole Sampo story right now. It's all about this massive strategic pivot away from complexity and towards just absolute clarity.
So how'd they pull it off? Well, it was a series of really bold, decisive moves. First, back in April 2022, they sold off their entire stake in Nordea Bank. I mean, poof, all that banking risk just gone. Then, late last year, they spun off their life insurance business, Mandatum. And while they were shedding assets, they were also doubling down on their core, moving to buy up 100% of the Danish insurer Topdanmark.
And this, right here, shows you the change perfectly. The old Sampo, it was this complicated beast. As an investor, you had to worry about everything. Interest rates, banking cycles, long-term life insurance headaches. But the new Sampo? It's a pure property and casualty insurer. That's it. It does one thing. It underwrites risk. And the goal is to be the absolute best at it.
So let's get into the bull case. Let's see how this new, focused company builds a really powerful investment story. And it all starts with what we're calling their Nordic fortress.
Now hold on. Before we go any further, there's one piece of jargon we absolutely have to know. The combined ratio. Look, in simple terms, it's just an insurer's expenses plus what it pays out in claims divided by the money it brings in from premiums. The magic number is 100. Anything under 100% and you're making a profit just from your insurance policies. It's really the purest measure of how good an insurer is at its job.
And this is exactly where Sampo just shines. I mean, look at that. Their combined ratio was a stunning 84.3%. What that means is for every euro in premiums they collected, they only paid out about 84 cents in costs and claims. They got to pocket almost 16 cents as pure profit. That is not just good, folks. That is absolutely elite, best-in-class stuff.
So where is all that profit coming from? Well, check out this breakdown. Almost half, 44%, comes from the private Nordic segment. We're talking about insuring regular people's homes and cars. This is the engine room of the company, a super stable, mature, and incredibly profitable market where Sampo is the king.
All right, but no investment is a sure thing, right? You have to look at the risks. So let's flip the coin and talk about the UK gamble, which is really the heart of any argument against investing in Sampo.
Okay, so just to recap, this is the foundation we just established. The Nordic business is a rock-solid fortress of stability and fantastic profits.
But while that core business is a fortress, the UK market is, well, it's a completely different animal. Through their subsidiary Hastings, Sampo was slugging it out on a genuine battlefield, one of the most competitive, cutthroat car insurance markets in the world.
And the dangers here are very real. You've got these price comparison websites that just create brutal, non-stop competition on price. That puts a constant squeeze on your profit margins. Plus, the market is super sensitive to claims inflation, the rising cost of car parts and repairs. It's just a way more volatile and cyclical business than their steady Nordic operations. This is the one part of the business that can really swing their earnings around.
So even with those risks in the UK, management has a crystal clear priority. Let's look at the shareholders' reward and the company's laser-like focus on returning capital.
Yeah, we started with this number and it's so important, it's worth seeing again. 7 billion euros. This wasn't some happy accident. It's the direct result of a clear, disciplined philosophy. Give cash back to the people who own the company, the shareholders.
And this isn't just a vague promise. It's literally written into their company policy. It's a simple, powerful 3-step process. Step 1, make a ton of money from smart underwriting.
Step 2, pay out at least 70% of those profits as a regular dividend. And Step 3, if there's any money left over after that, give that back too, either by buying back stock or paying a special dividend. It's a machine built to do one thing: generate cash and send it straight to investors. Okay, this all leads us to the million-dollar question, or maybe the billion-dollar question for any investor. What is all this quality actually worth? Let's dig into the valuation. Because look, when you have a company that's the best in its class and has a policy that's this friendly to shareholders, the market, it notices. And that means that quality is going to come with a premium price tag. And you can see it right here in the numbers. Sampo is trading at a price-to-earnings ratio of almost 22. Now compare that to the average European insurer, which is down around 13 times earnings. So yeah, there's no question about it. You are paying up for this stock.
So why are investors willing to do that? Why pay that premium? Well, it all comes back to the core strengths we've been talking about. The market is rewarding that elite, stable profitability. It's rewarding the clear, de-risked strategy. It loves the proven commitment to returning cash, and it sees a high return on equity, which is just a fancy way of saying management is incredibly good at using shareholders' money to make even more money.
Okay, so to wrap this all up, let's boil it down into a simple, actionable checklist. If you're looking at Sampo from here on out, what should you be watching?
Here are the 4 big things to keep on your radar. First, that all-important combined ratio. You want to see it stay below their own tough target of 85%. Second, organic growth. Are they still managing to grow premiums in those core Nordic and UK businesses? Third, capital. Are they still on track to generate and return another 4 billion euros by 2026? And finally, that Topdanmark deal. Are they actually delivering the cost savings they promised?
So, there you have it. That's the investment case for Sampo. It's a company that has totally remade itself into a focused, profitable, cash-returning machine. The final question for you, the investor, is this. With its crystal-clear strategy and its premium price tag, is Sampo a safe harbor in a choppy market? Or does that high price mean the market is overlooking the risks of the storm brewing over in the UK?